Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the banker fund flow indicator. This is a powerful tool that can provide valuable insight into the market dynamics. This indicator is designed to track the movement of large institutional funds, offering traders a unique perspective of potential price movements. Understanding and utilizing this indicator effectively can significantly enhance your trading strategy. You would explore how it works, what it reveals about the market sentiments, and more importantly, how you can incorporate it into your trading decision. So stay tuned until the end of this video to learn how to potentially improve your trading results by aligning your trades with the big players in the market. So there are some key components about this banker fund flow indicator that I would like to add in. And we have the first line, that will be the threshold line. The threshold line is the yellow line on this indicator. This yellow line, if I can zoom out, you see this yellow line on this indicator. This is called the threshold line. While we have the candlestick color, and this indicates the color code candlestick pattern to represent different market condition. We have the green, which indicates, when you see the green, it indicates increasing position. We have the white, which indicates decreasing position. We have the blue, all this blue we can see here. The blue indicates weak rebound, while the red indicates exiting position. So these are the key components you need to know about this banker fund flow trend indicator. Now let's see how we can incorporate this into our trading strategy, how we can master the banker fund flow. First of all, we set up our chart, and when we have set up our chart by including the indicator, we set up our chart by including the banker fund flow indicator to your chart for optimal results. We can also include the Hall suits indicator, which is this indicator you can see on the screen. The Hall suits indicator is this line indicator that follows price action, and we'll set it to a period of setting this Hall suits indicator to a period of 34. This will be the period we'll be using for this indicator, and we'll also include our volume oscillator to this strategy, including our volume indicator. So these are the three indicators you would need for this trading setup. The combination of this indicator will provide a comprehensive view of market condition. The step 2 is to identify potential entry points. The key to success with this strategy lies in recognizing color transition within the banker flow chart. This is the banker fund flow trend oscillator. This is what we are going to use for our long position. We look for the candlesticks to switch from blue to red or green. So to look for a long position, we look for our candlestick to switch from blue. As we can see, it's switching from blue to green. In this area, we'll be looking for our long position. So at this area where we can see a switch aligned with price action, we'll be looking for our long position on the chart. Conversely, if you are looking for your short position, you would watch the candlestick changing from green to red. We just need to check our candlestick. Our candlestick would have to change from green to red. Our candlestick changing from green to red would probably happen in this area. As you can see, this area of our chart, we can see price was on this indicator was showing green candles before it switched to red, and this would further signal in this area, further signal selling opportunities. So looking for selling opportunities will be at this area where the candle changed from green to the red. This is probably how we enter a selling position. We can also check when it changed from blue to purple on the threshold. When it changed from blue to purple on the threshold. Now third the third confirmation we need to use in entering a trade position using this strategy is confirming divergence. And divergence increase the probability of successful trades. You have to look for a divergence between price action and this indicator. How do we look for this divergence? A bullish divergence occurs when price make a series of lower low. If price is making a series of lower low and this indicator is making a series of lower high, as we can see in this area, price is making a series of lower low. But if we look at that particular area on this indicator, we can see that price is making a series of higher low. Instead of price to make a series of lower low, is making a series of higher low. This is basically where the divergence comes in. This is the higher low, signaling that there is a bullish divergence, and it means that we'll be looking for higher prices. When we see this divergence, it means price wants to reverse to the upside. Conversely, we look for a bearish divergence. It presents itself when price is making a higher high but the indicator is making a lower high. So when we see such situation, we would consider that a bearish scenario. Let's see if we can come up with, we can spot one of these bearish divergence so that we can better understand what divergence is with this strategy. So as I can see from this area on my chart, the price at this area is making a series of higher highs. As we can see, this area price is making a series of higher high, but the indicator in this area is making a series of lower high. In this area, as we can see, is making a series of lower high. This is a bearish divergence. The indicator is always going to make a different market movement compared to price action. When price action is making a higher high, indicator is making a lower high. This indicates a bearish divergence. So these are the conditions to spot potential reversals using this indicator. So divergence are really important to spot when making use of this indicator. To validate, you can use additional indicators. So before entering a trade, you can confirm using a trend direction of the Hall suit indicator. This is the Hall suit indicator. This particular trend following line we can see on our chart. So we can confirm the trend using the Hall suit indicator. Ensure that the volume oscillator is above zero line. When the volume indicator is above the zero line, this is the zero line, this dotted line crossing across, moving across the volume oscillator. Once it is above the volume line, it indicates sufficient market participation. This step helps you to filter out false signals and increase the reliability of your trade. So by combining with this Hall suit and the volume oscillator, we can capitalize on the opportunity. The Hall suit, it happens to be in a bearish trend when it is below the Hall suit indicator. When price is above, we are looking for buying opportunities. So we see how to execute our trade. Once all conditions are met, we place your entries. We place our trade by setting our stop loss. Once we enter our trade, when price, as we can see in this area, when we have seen the divergence, when we have spotted our divergence, first of all, spotted our divergence, this was our divergence in price, and with the indicator would enter our sell position when price is below the Hall suit. Remember, we set our stop loss above this recent high in a short trade and in a long trade you set it below the recent low. This is where we would enter. We just set our stop loss above the recent high. This is where we'll be looking to set our stop loss above this recent high. Then we aim for a minimum risk to reward of 1:1.5. You can aim for 1:1.5. This should be, or we aim for 1:2. This is the minimum risk to reward we should always aim for to ensure favorable trade outcome. The sixth step is to implement time-based filter. By incorporating time-based filter to avoid trading during po ten tial volatility or liquid market conditions, you have to focus trading during most active forex trading time hours, the time frame, typically when major financial market centers are open, typically the London section or the New York section. These are the times that you will be looking for trading opportunities and looking to enter your trade during the London section or the New York section using this strategy. Avoid trading during the hours before or after major economic news release, as this can cause unpredictable market spikes or price spikes. So by following these few steps you can easily capitalize on the market and capitalize on getting quick risk to reward profitable trades on using this setup. So you just need to practice this on your demo account first, align all the confluences and get better understanding of this trading strategy before you apply this with on your real life base, on your real chart or your real money chart. Alright traders, we have come to the end of this video. Do engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.